Welcome to Seven Bulls. We break down finance so that anyone can understand. Roll the intro.
In operating with what I call my circle of competence. And the most important thing in terms of your circle of competence is not how large the area of it is, it's how well you've defined the perimeter. If you know where the edges are, you're way better off than somebody that's got one that's 5 times as large, but they get very fuzzy about the edge, around the edges. And I can understand some kinds of simple businesses. I can't understand complicated businesses. Coca-Cola, what is it, about 110 years old now, and selling 750 million 8-ounce servings of their products a day around the world. Per capita consumption going up in virtually every country in the world after that 110 years or so, and it has 47% of the soft drink consumption throughout the world outside the United States, 41% of the United States, and gaining share every year. It isn't very complicated. I mean, you have to decide, A, whether it's a product that is somewhat durable, which I think has been illustrated, and whether the appeal is universal, which it certainly is, and then whether you have honest and competent management running it, which you most certainly do. Peter Lynch has always said, buy a business that's so good that any idiot can run it, because sooner or later one will. We would like to buy a business like that, and then we'd like a terrific guy running it. And we had 2 terrific people at Coke running it.
Hello, fellow investors. Welcome to Seven Bulls. Market crashes don't just shake prices. They expose the difference between investors who understand what they own and investors who only understand what something is worth today. During calm markets, almost anyone can feel like a genius. Prices rise, optimism sets in, and even the weakest companies can look unstoppable. But when the floor drops out, the truth shows itself fast. Suddenly, every share you own forces a question. Do you actually know this business well enough to hold it while the crowd is losing its mind? Before we move on, take a moment to like and share the video. It helps the channel reach more people by getting us into the algorithm. And don't forget to check out Seven Bulls, our professional-grade valuation platform for stocks, real estate, and long-term financial planning. If you need to run a DCF, run a company's net liquidation value, evaluate dividend income, or project long-term wealth, our Pro Series gives you serious tools without the complexity. The link is at the bottom of the screen. Now let's get to it. Now let's get into the reality most people overlook. Markets are not built on logic, they're built on behavior. The madness of crowds is not a rare event, it's the engine that drives the market forward. People chase what's rising, panic when it falls, and rarely stop to ask what the underlying business is actually worth. This is why retail investors repeatedly lose money during major downturns. It's not because the system is unfair, it's because the system rewards patience, understanding, and discomfort, 3 traits the crowd almost never shows. In fact, the stock market, from its earliest days, has functioned as a mechanism that quietly transfers wealth from the emotional to the disciplined. The wealthy, the institutions, the long-term thinkers, they all understand one thing. Crashes are not interruptions. They are part of the natural rhythm of capitalism. They clear excess, they correct unrealistic valuations, and they create opportunities for those who aren't blinded by fear. That's why big money doesn't panic. They've studied the businesses they own. They know the difference between a temporary price shock and a true decline in value. But most investors never reach that level of understanding. They buy companies because the chart looks strong, or because someone online mentioned a hot stock, or because they saw green candles and assumed it meant something meaningful. Then the crash comes, the price drops 20, 30, 40%, and suddenly they have nothing to anchor themselves to. Without conviction built on research, the only thing left is fear. Knowing what you own is not just a slogan, it is the antidote to panic. When you understand a company's cash flows, margins, balance sheet strength, competitive advantages, and long-term prospects, the market's mood swings stop controlling your decisions. You no longer see volatility as a sign to run. You see it as an opportunity to buy into a company you believe in at a discounted price. This is how wealth is built during downturns, not by avoiding crashes, but by staying rational through them. Crashes, recessions, and depressions will always be part of the economic cycle. They are unavoidable, but they are also necessary. They remind the world that value is not defined by price, and that markets reward those who stay grounded in reality. The investors who thrive are the ones who understand their holdings deeply and aren't scared out of their positions by noise. Meanwhile, the crowd which never looked past the stock symbol sells at the worst time and wonders why they never seem to get ahead. The truth is simple but not easy. If you want to survive the next crash, know what you own. Know why you own it. Know its real value, not just its current price. That understanding turns chaos into clarity and fear into opportunity. If you got anything from today's video, remember to give it a like and share. Also, feel free to leave a comment. It helps way more than you think. Keep up with your financial education. You're the only one in charge of your future. Be safe.
Seven Bulls.